Welcome to the first episode of Taipan Publishing Group's Option Blackboard. My name is Adam Lass. Before we get started talking about options and why you should mess with them, let me give you a quick background about me. Currently, I serve as editor of Wave Strength Options Weekly, an options trading service based on history, economics, value, and technical analyses. I also serve as a regular contributor to Taipan Daily with our editorial director, Justice Lytle. Now, I've been trading and writing about stocks and options for more than a decade. But before that, I was just a regular business guy like so many of you. And much like you, I thought stock options trading was an overly complicated little corner of the investing world best left to the experts. But the profits, they sounded really nice. I'd even heard that sometimes you can double your money in a matter of days. But seriously, all that confusing jargon and the risks. My friends kept telling me horror stories about fellows who had lost out when their big contracts expired or were forced to pay out money on short sales. Boy, am I glad I took the time to learn from some of the best former floor traders in the business, because it turns out that in many ways option trading is less risky than stock trading. All that jargon can be boiled down to a few simple terms that really do make sense, and the potential for profits is really quite amazing. In the Option Blackboard series, I will show you exactly what stock options are and how you can put them to work for you. I will translate all the really important stock option terms into straightforward English. I will explain how to choose, buy, and sell stock options. And I will reveal the secret of delta, the number that predicts how much more money options can make compared to stocks. Trust me, when we are done, you will be an absolute whiz at this stuff. Over the next few episodes, we will look at the 4 basic things you can do with stock options. In episode 1, first, you will have to understand exactly what a stock option is. Now, a share of stock is pretty familiar to many of you. When you buy a share of stock, you own a small piece of a company. Seems simple enough. An option is entirely different. An option is a contract between two parties, and like most all contracts, one party pays money and the other promises to do something. Now, this is really important. The party who does the buying is in complete control here. No one can make them do anything they don't want to do. I'll get back to this point again in a moment. Now we're going to get into some of that notorious jargon. But don't be nervous, because the terms really do make sense. There are 2 kinds of option contracts, calls and puts. First, calls. Calls are in essence a bet that a stock will go up. Here's the jargon in use. In a call option contract, the buying party pays money to acquire the right, but not the obligation, to call 100 stock shares from the seller at a certain price, that's called the strike price, before a certain date, and that's called the expiration date. Okay, breathe. What we really mean is, it doesn't matter what the stock is selling for. It could be $1, $10, or even $100 a share. You've got a contract that says the other guy has to pony up 100 shares whenever you say so. You can keep the shares for your personal portfolio if you like, or you can sell them on the open market for an immediate profit. What's more, you can even sell the option contract itself for a profit if you like, without ever messing with the stock shares. Now, a put is the exact opposite of a call. Here, you are banking on a company's stock shares going down. The put contract buyer pays money for the right, but not the obligation, to put 100 shares of a stock to the contract seller for a certain price before a certain date. Doesn't matter how low the stock goes, 1, 10, or even $100. In fact, the lower it goes, the better. When you are satisfied that the stock is as low as you figure it's going, you can exercise your right. You then buy 100 shares on the open market and force the other guy to take them at the price you both agreed on. The difference between the low price you pay on the open market and the higher price he has to pay is your profit. Or, if you like, you can sell the option contract for a profit on the open market, again, without ever messing with the hassle of buying and selling stock shares. Now let's take a moment to review some lessons learned. Calls, for instance. You are always in complete control. You get to keep the shares if you wish. You can sell them on the open market, or you can sell the option contract itself. Now, lessons learned with puts. You can buy the shares on the open market, force a seller to take the price agreed on, make your profit that way, or sell the option contract for a profit on the open market. It really is that simple. Okay, that was simple because I left a few details out, but don't worry. In the next few Blackboard sessions, I will start ironing out all those little details. In fact, in session 2, I will map out exactly how a call works, when you should buy one, when you should sell one, and even the special codes you need to tell your broker what to do. Until then, send additional comments to adam@taipandaily.com. Thanks again for joining me, Adam Lass, in the first episode of Taipan Publishing Group's Option Blackboard.